The food court at Pittsburgh Mills smelled like soft pretzels and something close to permanence. The kind of place where you would kill a whole Saturday and come home with nothing in particular and not really mind. 900,000 square feet. Kaufmann's, Sears, J.C. Penney. Over 150 stores, a food court, and a parking lot that filled on weekends the way parking lots fill when a community believes in a thing. The Galleria at Pittsburgh Mills opened on July 14, 2005, in Frazer Township, Pennsylvania. It was financed with $133 million, a commercial mortgage originated by Wells Fargo, packaged into a commercial mortgage-backed security, then sold off to investors across the country who expected steady income from a new regional mall. In January 2017, Wells Fargo executed a consensual foreclosure on that property. The sale price was $100. $100 for a 900,000 square foot mall that a community built its retail identity around. And the people who structured that loan did not lose money. They were paid to process the loss on the way down. If you grew up going to a mall and you are watching it sit empty right now, this is what happened to it. Here is the instrument that made that possible. Here is why it is embedded inside the debt structure of almost every mid-tier mall in America. And here is who profits every single time one of them dies. The mall was not built to fail. It was built to be a bond. Those are different things, and the difference is why a building worth $133 million can sell for the price of a fast food lunch. Victor Gruen designed the first enclosed American shopping mall in 1956. His intention was to create a civic space, a gathering place in climate-controlled comfort for communities that had built suburbs without town centers. He wanted fountains, community events, a place that felt permanent. What he got, eventually, was a financial instrument. By the 1980s, regional malls were the highest-yielding commercial property class in the country, and Wall Street had figured out how to package them into bonds. Here is how that works, and why it matters to what happened in Frazer Township. A bank originates a loan to a mall developer. Instead of holding that loan, the bank packages it with dozens of other commercial real estate loans, slices the combined pool into tiers ranked by risk, and sells those tiers to investors across the country. A pension fund buys the safe tier. A hedge fund buys the risky one. Your retirement account may own a slice of the loan on a mall you drove past last weekend without a second thought. The bank that originated the loan no longer holds it. The moment the bond sold, the originator had no financial skin in whether the mall succeeded or failed. Its incentive was to make as many loans as possible, package them fast, and move the risk somewhere else. That's called originate-to-distribute, and it's the same structural problem that produced the mortgage-backed securities that collapsed in 2008. The mall version has been running the same sequence, quietly, for 15 years. By the end of this video, you'll understand why it wasn't stopped and why it's accelerating right now. Think of it this way. When a car dealer sells you a car on credit and then immediately sells that loan to a bank, his incentive is to write as many deals as possible before the bank stops buying. He does not care if you can make the payments. He has already moved on. The mall version worked the same way. The originator made the loan, collected the fee, packaged it into a bond, sold the risk to investors who would never see the building, and moved on to the next mall in the next suburb with the next community that believed in it. You probably remember the year your mall lost its first anchor. Maybe it was a Tuesday and the Sears wing just went quiet. The lights still worked, the escalators still moved. You could hear the ventilation hum in a corridor where the echo used to get swallowed by foot traffic. The hallway that carried 500 people past the storefronts now carried 20, and the sound of your own footsteps followed you in a way it never had before. The pretzel cart was still there. The guy who worked it had stopped making eye contact by February. That feeling had a name inside the lease binder. It was called a Co-Tenancy Clause, and here is the one thing the mall never explained to the community that depended on it. Every mid-tier mall built between 1970 and 2005 wired its small tenant leases directly to its anchors. If a named anchor vacates, smaller tenants earn the right to reduce their rent, typically 25 to 75%, and sometimes to walk entirely at no penalty. On its face, this is reasonable. The jewelry kiosk signed that lease because Sears was pulling 14,000 people a week past its display case. Remove Sears, and the hallway goes quiet. Why should that kiosk pay the same rent for space nobody walks through? But the Co-Tenancy Clause does not hit one tenant. It hits every tenant whose lease references that anchor simultaneously on a fixed timeline. From 90 to 180 days after the departure is confirmed, the clauses execute across the property like circuit breakers tripping down a panel. Rent drops 25% here, 50% there. One tenant walks entirely. The food court loses its anchor. Then it loses its reason to stay open past 6. Rent drops by formula. Net operating income collapses, and that collapse triggers the next mechanism. Every CMBS loan embeds a covenant requiring the property to maintain a minimum ratio between net operating income and annual debt payments. The standard threshold is 1.25 to 1. For every dollar owed in debt service, the property must generate at least $1.25 in income. When co-tenancy clauses shear rents across an entire mall, income crashes below that ratio. The loan enters technical default, not because anyone missed a payment, because a formula broke, because the building's income could no longer cover its debt by the margin written into the bond 30 years earlier. And once that threshold breaks, control transfers to a special servicer. That's when the fee clock starts. Here's the part most mall content never reaches. When a CMBS loan starts failing, it moves to a special servicer. That firm's job is to maximize recovery for bondholders, not to save the building for the community. In most CMBS deals, they collect fees tied to the loan balance and an ongoing servicing fee for every month the property stays in workout. The longer the process drags, the more they collect. The firms that have significant say over which company becomes special servicer are called B-piece buyers. They purchase the riskiest slice of the CMBS stack, and in most deals, that gives them major influence over who handles the workout when a loan goes bad. The key players in the mall sector include Rialto Capital, C3 Asset Management, and LNR Partners. Most people have never heard of these companies. They specialize in distressed real estate and built their business model around deals that are already failing. Pittsburgh Mills didn't fail because Frazer Township stopped caring about its mall. It failed because a financial instrument buried in its mortgage aligned every professional incentive against a fast recovery and against the community that had been paying into the system for years. Pittsburgh Mills ran the full sequence. Anchors left. Co-tenancy clauses fired across the lease book. Net operating income collapsed below covenant threshold. Wells Fargo executed a consensual foreclosure. Sale price, $100. $133 million in debt. $100 in recovery. The highest retail CMBS loss severity on record. That isn't a story about a community that stopped going to the mall. It's a story about a financial instrument designed to distribute risk away from the people who created it and onto the people who lived near it. If you recognize this pattern in a mall near you, stay with this. Because the scale of what's happening right now is significantly larger than one building in Pennsylvania. The mechanism doesn't care about the building. That's the detail that matters. Take Destiny USA in Syracuse. It is the biggest mall in New York State. It had about $430 million in CMBS debt, and back in 2014, it was valued at roughly $710 million. By late 2025, the owners had defaulted on their mortgage. Its estimated liquidation value was $65 million. That is a 91% collapse in 11 years. Palisades Center in West Nyack followed the same sequence. It had about $418 million in CMBS debt, and in 2016 it was valued at $881 million. Then in February 2026, it was listed at auction at $175 million. That is an 80% loss over 10 years. The anchors left, the clauses fired, and the coverage ratio broke. The same steps, the same order, a different zip code. Westfield San Francisco Center had $558 million in CMBS debt. It peaked at roughly $1.2 billion in 2016. Nordstrom left in 2023, and the Co-Tenancy Clauses followed. By February 2026, the property was listed at $100 million. That is a 92% wipeout in under a decade, in one of the most expensive real estate markets on earth. These aren't flukes. They aren't cautionary tales about overbuilding or Amazon or changing habits. Those are the conditions. The kill switch is the commercial mortgage-backed securities structure, the originate-to-distribute incentive that disconnected the lender from the outcome, the co-tenancy clause that detonated income at the first anchor departure, and the fee structure that made slow decline more profitable than fast resolution. Same instrument, same sequence. Different buildings, different cities, different communities that built something real and watched a mechanism they never heard of take it apart from the inside. In every one of these cases, the anchor tenants announced their departures in press releases that described strategic repositioning. The bondholders received workout reports from special servicers. The communities received nothing. No notice, no explanation, no language in any public document that described the co-tenancy clause, or the coverage ratio, or the fee structure that was running beneath the surface of a building they had spent their weekends in for 20 years. And here is why it is accelerating right now, in 2025 and 2026, at a rate that is triple what it was 18 months ago. You might own part of this. As of the fourth quarter of 2025, CMBS retail delinquency sat at 11.1% for regional malls, according to TREP data. That is up from 4.2% in the first quarter of 2024. In less than 2 years, the distress rate nearly tripled. The reason is the maturity wall. Most of the CMBS loans originated between 2014 and 2016 and carried 10-year terms. Those loans are hitting maturity right now. Mall operators expected to refinance at similar rates, but instead they are facing a lending market where borrowing costs are roughly double what they were when these loans were written. A building underwritten at low interest rates cannot service the same debt load when borrowing costs double. The math breaks, and the special servicers are collecting their fees while properties sit in workout. The pension funds, endowments, and insurance companies that bought those CMBS bonds are now sitting on distressed positions across the regional mall sector. Large pension funds and retirement accounts have historically held CMBS securities, which means some of that risk ends up sitting in retirement portfolios without appearing as a line item on any statement you have ever received. You were in the food court on a Saturday afternoon. Your retirement account was in the bond. Neither of you knew the other existed. If this has made you think differently about which mall in your town has gone quiet, share this video. The mechanism is invisible until someone shows you where to look. Subscribe now, and the next video in this series runs the same lens on something you probably still use. Here is the question that separates this from every other dead mall video. Not, why did malls die? That question gets the same answer every time. Amazon, online shopping, changing habits. Those answers are true, and they are incomplete. The real question is, who got paid to manage the death? The CMBS originators collected their fees up front. Banks like Deutsche Bank, Wells Fargo, UBS, Barclays, Morgan Stanley, and JP Morgan. They packaged the loans, took their origination fees, and sold the risk before the anchors started leaving. By the time the co-tenancy clauses started firing, they were already on to the next deal. The B-piece buyers built their return model around the assumption that some percentage of these loans would fail. The failure was not a surprise. It was underwritten. The special servicers collected fees on every property in distress. The longer the process continued, the more they collected. no one in this chain did anything illegal. Every contract was signed voluntarily. The California Supreme Court ruled in December 2024 that co-tenancy clauses are enforceable, meaning tenants can legally reduce rent or walk when an anchor leaves. The courts confirmed it is exactly what it was designed to be. What the courts cannot address is what the mechanism does to a community that built a gathering place and then watched the financial structure wrapped around it extract every dollar on the way down. The people who designed the instrument did not live in Frazer Township. They processed the loss from a desk in New York and then moved to the next file. Pittsburgh Mills is still there, Frazer Township, Pennsylvania. Most of the stores are closed. The food court serves a handful of customers on weekday afternoons. The parking lot that used to fill edge to edge on Saturdays now hosts weekend flea markets in the corner near the old Macy's entrance. Properties like this one often end up in the hands of distressed asset buyers. Namdar Realty Group, one of the largest distressed mall acquirers in the country, has assembled portfolios of dozens of malls that have run this sequence. Their strategy is documented and public. Acquire at post-spiral discount. Extract residual rent from remaining tenants. Invest minimal capital. Hold. A mall appraised at $190 million, bought at foreclosure for $100, does not need substantial income to generate acceptable returns. The kiosk that still sells phone cases, the nail salon, the one open restaurant in the food court, they pay something. Something on a $100 cost basis returns a yield the original bondholders could never have achieved at $190 million. The mechanism that destroyed the institutional valuation created the buying opportunity for the people who understood the sequence before it ran. The community in Frazer Township did not understand the sequence. They were not supposed to. If you have watched a mall go quiet in your town, you have likely seen this run. The first anchor closes. The hallway gets quieter. The second anchor follows, and suddenly, half the stores are running on reduced rent and counting their months. The food court loses its anchor restaurant. The building enters special servicing, and a notice appears in the window that does not explain what special servicing means, or who is now making decisions about the building where your community used to spend its Saturdays. And then one day, someone from a company you have never heard of buys the property at a number that does not make sense to anyone who did not read the bond documents. Some of those malls were in cities that had nothing else like them. The mall was the gathering place, the first job, the date spot, the Saturday errand that turned into an afternoon. When it entered special servicing, none of that showed up in the workout report. The special servicer's job was the bond, not the Saturday afternoon. That sequence has played out in over 1,000 American malls. It is playing out in hundreds more right now, on the timetable written into leases and CMBS covenants 3 decades ago. The clause that forced it was contractual. The instrument that accelerated it was financial. The communities that lost something were the collateral in a bond that was always designed to be someone else's problem. If you have watched a mall disappear in your town, subscribe. The same debt structure, the same originate-to-distribute model, the same fee incentives that have been running this sequence across American retail for 15 years are not finished. They are inside something else you probably still use, something carrying far more debt per square foot than any mall ever did. That story is next.